Hey Future Millionaires, this is Phil from the Next Chapter team, and today's article review, we're going to go over 12 different money tips, money actions you could be taking to help you multiply your wealth like the super rich. And you know what, I gotta say, a lot of these things you can be doing. A lot of them are things that everyday people can be doing. Please take a moment to hit that like button, subscribe, and share some friends and family. Now sit back, relax, and then enjoy this article review from the Next Chapter team. The first tip that the article calls out is the importance of having a diversified portfolio. And it calls out some great options that you should look to do within your overall portfolio when you're building wealth. Things like a 401k, an IRA, perhaps even doing some real estate investing, low-cost index funds, some stocks and bonds, and then high-yield savings accounts. A mix of all these things can really help you build wealth over a long time. Because in each section you have different levels of risk, and then you can assess what you want to invest in, and you can do it consistently. And that's why we do so many ETF reviews, because you have mutual funds in your 401k and then ETFs in your IRA. There are so many options out there, and you could slowly pace into these things over time. Don't jump in and try to do them all at once. Pace into them over time and do them consistently, and you're going to build some serious wealth. So a great first tip. The second thing that the article calls out is the need to focus on exponential returns. And what they're really saying is utilizing things that help you get compounding interest. So in that high yield savings account, because you're building up money and you leave it there, that interest grows on top of it. So compounding interest within the high yield savings accounts. And then you have dividends paying stocks inside your general investment accounts. Those dividends, you reinvest the dividends and it builds on itself. Those ETFs and REITs also build on themselves, the rates of returns. By having it stay in there and reinvest on those returns, your balance grows more and more and more and more over time. Next up, the article calls out being strategic with your taxes. It's important to have a strategy of what you want to do with taxes. There are going to be phases in your wealth building journey that you're going to be wanting to be very heavy with doing pre-tax contributions and therefore lowering your taxation. And there are going to be other phases in your life where you don't need to be. All right. But it's important to seek advice. So they're talking about the importance of being strategic with taxes. And you know what? You graduate to these points. You got to look at this as one of those things that eventually you're going to get there. Next up, the article calls out that at a certain point, you get to a point where you become an accredited investor because you have enough assets. And when you become an accredited investor, it allows you to invest in things like pre-market IPOs. So that's before initial public offerings of a stock, new startups, high yield ventures, and even private equity deals. Now, this is a graduation point. This, like I said at the very top of the article, there are certain items that everyone could do right away. This is not one of those items, and that's okay. You don't even necessarily need to do this to build up that long-term wealth. But at some point, you may get there. But this is about getting to that point. The article calls out the importance of getting to the point and really being a well-versed investor before you go down this path. This is not for your novice because there's high risk, which will, of course, does have the opportunity for high returns, but it's very high risk. And you don't technically need to do that very early on. In fact, very early on, the basics of a 401k and an IRA is great. And you could do some serious money in there. Then in your investment accounts, you could do even more. Next up, the article calls out, and I love this one. Well, it's an old school term, pay yourself first. But what they're really saying is be intentional with your money. And when you get paid, be intentional about diverting some money to savings, diverting some money to investing. It's not just pay yourself first. It's divert the money, direct it to where you want it to be so it can be invested. And then further, and we talk about this a lot in the ETF reviews, is automatic transfer into that ETF, that IRA account or investment account, and then automatic purchase of those things you want to keep purchasing. And that way you get a chance to dollar cost average. So it's not just pay yourself first. Let's enhance that. It's direct that money to where you want it to be and live on a good spending plan. We're going to get more into that in the other section. Next up, it's important to adjust your risk tolerance over time. And this is really important. In your earlier years, 20s, 30s, even early 40s, you could have a higher risk tolerance than when you're in your late 40s, 50s, 60s, and 70s. Of course, you don't want to have too much in the market at that point, but especially when you're doing this fine tuning, it's a good idea to work with some type of financial advisor to help you get comfortable with the actions you're taking. There are financial advisors that are fee-based, and there are ones that are percentage-based. So you just got to find the right one that works for you. So adjusting your risk tolerance over time. You don't want to have all of your money sitting in savings accounts, even high-yield savings accounts, when you have more than your emergency fund. Unless you're saving up for a big purchase that you think you're going to do really quickly under 5 years. But when you are really at the point where you have a good amount to divert to investing every year, or even every month, you want to adjust your risk tolerance, especially after you get past that emergency fund. From there, you want to take on a little more risk by putting it in areas in the market that you're comfortable with. But you got to do your research. You got to do your homework. Next up, the article calls out the importance of a lot of individuals want to build generational wealth. Now, this is a big preference one. You don't necessarily have to build generational wealth, but it's a good goal, right? It's not a bad goal. And in fact, sometimes it just get there. You have so much money at the end because you've saved habitually that you live a very nice retirement. And then, there could be some health issues, but at least you have the money. And then whatever's left, you could leave on to your legacy, or you could donate it all. There are people that do that. They just donate a crap load and they're passing. Sometimes they donate a crap load before they're passing. They're just really investing and giving back early. But building generational wealth, whether it be through something philanthropical or even to family members, this is really a big preference thing, but it helps you stay motivated by building that wealth. That building generational wealth is more a motivational key than anything else. So next up, never passing on passive income. And the article calls out when you get there, this is one of those ones, again, you mature to. You can have passive wealth that you're active in, your passive income that you're active in, but there's also passive income that you're not as active in. Buying rental properties, buying a REIT. A REIT is a real estate investment trust, but rental properties, it's pseudo-passive. Remember, there's going to be maintenance and insurance and other things on that property. Other things, you can invest in businesses, become a silent partner. You could even at some point sell intellectual property to gain royalty income. These are other avenues that you can utilize to gain and build wealth over time. Another one, not a big fan of this, but I'm going to call it out. It's in the article, leveraging where you can. And what they're talking about here is borrowing against your investments to make other investments. This is a very advanced move. This is not for the novice, not for the faint of heart, and you can have some serious money to do this. So some of us will graduate. Someone viewing this will graduate to that point. They'll have some major money, and they get there. But I wouldn't do it with all my money. If you got there, if you're diverting like 5 or 10%, okay, but would you divert a whole 100%? Would you leverage a whole 100%? That's crazy. If you graduated to being a multimillionaire, a deca, so over $10 million, would you really leverage all 10 million just to go further? That just seems crazy, especially if you're in your latter years. This is a real risky play. Not a fan of this one, but again, some people graduate to this. Well, I like this one, taking advantage of your network. And what they're really talking about is building on a network of individuals who are financially savvy just like you. Someone you could trade ideas with, that you could talk through, moving and building wealth. Real estate clubs, investing clubs. Just be careful about the investing clubs so you don't get pulled into some type of investment scheme. But really talking about this, talking through strategies, talking through actions you're going to take. It helps also builds an accountability group, right? Because you want to be accountable. You want to talk about, hey, we're going to do this, and you walk through the mechanics of it. And you know what? Someone's going to talk to you a month later, and they're going to hold you accountable. Did you do it? And if you didn't, why not? Right? It helps you have a good sounding board too. So building on a network of individuals who are financially goal-minded as well, who really are looking to build wealth. Just like the last one, building on a network of individuals who want to build wealth. This one, living below your means. This one you can do. The last one you can do, this one you can do. Anybody, whether they're making $70,000 or $300,000, living below your means is one of the key ways to help you become a future millionaire. Because if you live on less than you make and you have an emergency fund and you're sending that extra money that you don't need per month, per week to investment accounts, and you're investing it wisely, like all the other steps we just talked about, over time you're going to build wealth. The last one, furthering their financial education. Tip number 12. always being willing to further financial education, reading books, reading articles, sometimes taking free training courses, or even small paid for training courses. These things will help you understand ways you could build wealth, help you fine tune your approach for you. Everyone's wealth building journey is different. Everyone's journey is different. So you've got to fine tune it to help you build wealth. And for people who don't have kids, they're probably not looking to build such a huge legacy, right? They may have some legacy that they want to build up, given some of their retirement income and their event of their passing to a niece, nephew, cousin, etc., right? Or they want to donate a portion of it. But everyone's journey is different. And the best way to get good ideas is to work with others, just like networking, financial education. These are ways to help you really lean in. To finally, as the article points out, one thing, this is mind over money. That's right. A lot of this is about attaining the right knowledge, the right perspective to take action to make results over time. And so, at the very beginning, it's going to be slowly. But that's okay. You've got to be patient. I always talk about this. Why we do the ETF reviews in 5 or 10 years? Because this is a slow buildup. And then it hits a point when that compounding interest is awesome. It's just growing, growing, growing. There also hits a point. Also, this is amazing. For all those people who are 401k millionaires, they know this. They will have more growth in their 401k than their contributions. Hopefully that blew your mind. So think about that. They have more growth in their 401k annually than what they're contributing annually because they've been at it for a long time. They've been socking away the money, steady investing, not being wavered. They're living below their means. They're employing so many of these basic but great fine-tuned tips to their everyday financials. And that's how they're building wealth. Hope you found this enjoyable. See you in the next one. And now a quick recap of the 12 tips that will help you build money like the super rich. First off, again, diversifying your portfolio. And this is about not having all your eggs in one basket and then having some areas where you're a little more risky than others, but overall spreading your dollars out over time and then building up wealth in different ways in each of those accounts. Next, focusing on exponential returns, or better stated, focusing on compounding interest. Being sure and understanding the fact that building wealth, long-lasting wealth, is about doing it over a course of time and not exceedingly quickly, because it just doesn't always happen that way. Sometimes it does, but that's, the stats are not in everyone's favor. Third, being strategic with taxes. And again, this is one of those ones that eventually you graduate to. Many of us, this is not a big issue initially, right? But there hits a point where you have to figure out, my income's so high, as well as I have so many options. What strategically makes the best sense for me, investing and tax-wise? Fourth, creating better investment opportunities. And that is through getting to a point. So this is one of those ones I said early on. This is about graduating to a point. This is one of those graduation ones. You graduate to a point where you have so much saved in investment accounts and other accounts that you graduate to a class called accredited investor, which really means you're allowed to do investing into IPOs and startups and things of that nature. You have to have some really big money to do this usually. Fifth, paying yourself first. Again, let's state this more correctly. Paying yourself or directing your money more correctly to your money goals. So things like high yield savings accounts when you're building up an emergency funds. And then after that, maxing out an IRA, and then circling back and then maxing out your 401k. Again, your 401k is going to be limited to what your employer offers versus your IRA is going to be limited to what the investment firm that you work with offers. And that's going to usually have more options. And number 6, adjusting your risk tolerance. This is important because, again, at some point after you have an emergency fund, which is going to be in a very safe spot, FDIC insured bank of some form, or FDIC or the credit union insured credit union, where that money is very safe. That very safe money is going to grow at hopefully competitive high yield interest rate, but it's not going to beat the market. Statistically speaking, it's not going to beat the market. You want to have a good portion of your money in the market or in places that you understand, right, that are going up, that are beating inflation. The number 7 tip, and again, this one is very much up to you, but it helps you stay hungry and helps you stay focused. That is building generational wealth. And again, for those of us who don't have children, building generational wealth can really mean be focused on giving back philanthropically, giving away to charities and such, or even giving to a relative that you really care for, niece, nephew, etc. Right? Number 8, never passing on passive income. Well, really what they're really saying there is getting to the point where you can have some REITs and other such things that build income up or derive income when you're not working. Number 9, this one I'm not a huge fan of, but it's in the article, is leveraging where you can. And what they're talking about in the article is leveraging, taking loans out against your investments to further invest. I don't really love this one. This one's not for the faint of heart. You've got to be at almost expert level to go there. The everyday person should not really go there. It's just too risky. Number 10, taking advantage of your network. Let's state that a little better. It is building a network. Building a network of individuals that you can have great money conversations with, life conversations with, and you know what? They're also going to help you stay accountable on your journey to building wealth. Number 11, again, this is one of those ones, just like number 10, that everybody can do, is living below your means. You live below your means, it helps you do all the other things on this. And you know what? Living below your means does not mean you don't get to live some life you enjoy. You just got to save up for it. Don't cycle around with too much debt and wonder why you're not making traction on building up money in your IRA or even an investment account. And finally, wrapping up, but I know you know this one because you're watching this article review, furthering your financial education. It is so important to put this in the mix of your game plan to become a future millionaire. It is important to hire your financial education, increase your financial literacy, and sharpen it by talking it out with others. This is a great article. Again, I would say at least 10 of the 12 items I'm a huge fan of. See you in the next article review. Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please take a moment to hit that like button, drop a comment, subscribe, share with your friends and family. This will help the channel reach out to more individuals just like you. We offer one-on-one coaching where we work with people and small businesses to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. So please see our link below to schedule a free 30-minute call with our team to talk through coaching and understanding your current financial situation. Also, check out some of our affiliate links below for High Yield Savings Account. This is a great place to put your money when you're saving up for those big purchases and your emergency fund. Check out some of our videos right here. And please enjoy and see you in the next video.